Hi everyone, and a very warm welcome to Openbank's live market flash. We're delighted that you've joined us today. Before we start, I'd like to stress that you have the option to listen to this live market flash in your local language. You can do this by selecting one of the language options on the side of your screen. The purpose of our live market flashes is to provide you with an update on the markets and to complement the updates that we send you to our customers via email. I hope it will be a very interactive and interesting session. Please let us know if you have any questions, submit them through the question submission option, and we'll try to answer them. My name is Nikki de Haas. I'm delighted to have Gonzalo Pradas with us today. Gonzalo is our Director for Wealth Management in Openbank. Hi Gonzalo, welcome. How are you?
I'm very good, Nikki. Hello, how are you? And hello to everybody that is joining us today. I hope we can make it as interesting and entertaining as possible.
Good. Gonzalo, of course, we are all aware of the very concerning situation regarding the Russian invasion in Ukraine. Looking at this conflict from an investment point of view, I'd like to start asking you, how can this blockade of Russia via sanctions and the reactive measures taken by this region, how can they affect the financial markets?
Well, negatively, for sure, because those sanctions are indeed configured and built in order to strangle Russia and to try to make them aware that they should stop with this way forward that they have decided. But of course, for markets, from financial markets, this have a negative effect. The question is how negative and where. The where, Europe. Of course, the war is happening in Europe, and Europe is going to suffer the most via the prices of commodities, via the rationing or maybe blocking of the supply of those commodities. And of course, because of the ties, both on the supply side and the demand side, that Russia and Ukraine could provide. More generally, based on factories from inland Russia, etc.
Okay, and you've been mentioning this tightening of the supply of oil and gas and certain commodities. Could you specifically share with us what would be the impact in the various equity sectors?
Yeah, so first, let's start with oil. Oil has touched $120 this week, to give a big figure. And that means that, of course, the oil producers, oil handlers are benefiting in stock exchange for sure. But at the same time, other companies that are more linked to the disposable income of families, of households, are suffering. Consumer cycle, autos also, automobiles are suffering today very much, and also banks. The financial sector is suffering nowadays. That in regards to the impact of oil, but there are other commodities. For example, palladium. Palladium is Russia is the #1 producer of palladium, and we have all learned during these days that now you cannot build one car without palladium. So automobiles, again, second negative effect for this sector, are being affected for the potential shortage of supply of palladium.
Yeah, and another topic of interest is inflation, of course. Do you think that this Russia-Ukraine conflict will scupper any government plans to contain inflation?
Yeah, this is a very meaningful topic and a very good question, because inflation has been a topic since many months now. And inflation, we have been saying that, was spectacularly high and will remain so until mid of this year. maybe May, maybe June, to fall to a higher level than average, but lower than today. Now, the effect of the war is going to make inflation be spectacularly high for longer. We don't know how much, how longer. Is it the end of this year, or is it a bit shorter during autumn? We don't know yet, but of course it's going to be here for longer, and as spectacular as it is today. But central banks, we believe, are going to address it, approach it differently. There is different types of inflation, and the inflation we have been suffering, so to say, until now has been an inflation provoked or happened because of a boost in demand, a spectacular boost in demand, and a blockage of supply lines due to the lockdown, COVID related measures, etc. Now we're talking about an inflation due to war. And war inflation, typically, historically, is sort of left alone from a point of view of the central banks. So what we will see is, due to this new inflation in regards to the origin of it, but the same level, we will see a different policy stance from the Federal Reserve and from the ECB.
Okay, and about the interest rates, do you think that these geopolitical risks could cool the interest rate increase outlook for this year? We are all aware of what the announcement were. How would this be affected?
Yes, it will cool down, and it has cooled down the market expectations, so to say. The most prominent example is what has happened with the expectation of a rate increase in March by the Fed. People, a lot of players in the market were betting, and allow me to use this verb because I believe it was the way that they were deciding, betting on a 50 basis points increase in March. Now, miraculously, after Jerome Powell's speech on Wednesday, they have gone back to an expectation of a 25 basis points increase, which is what we thought it was going to happen. So it is not that, maybe not that central banks are cooling down their path of rate increases, but that the market is seeing a different path, a different pattern. Because I wouldn't say that the war is sort of an excuse or a scapegoat that the Fed will use to instead of increase 8 or 9 times, 8 or 9 quarters this year, the interest rates only increase 4 or 5. I believe that, of course, taking into account that they've made some mistakes in communication and they've been too aggressive, way too aggressive in communicating what they were going to do. We from Openbank, we were believing at the very end of last year and today that it would be more on the 4 to 5 quarters increase camp rather than the 8 to 9 quarter increases.
Okay, and then in a different direction, because we normally send to our customers, as mentioned, we send the market flashes on a periodic basis. Do you still favor the US over European indices? Because that's something that you've been mentioning.
Yeah, even more than before. So now, and of course, volatility is so extreme, and you see markets today. Europe is suffering another big sell-off, which we believe will recover when volatility is high. This high volatility is out of scope, but you can see the gap between United States and Europe. Even though we haven't taken profit of that because we are looking at a potential increase in exposure in US. And reducing it in Europe. We haven't done that because of, as I say, the high volatility and uncertainty that we see. But it's clear that Europe is going to suffer the effects of this war that are linked to what we said before, commodities mainly. shortage of commodities, energy, etc. But the US is 100% independent energy-wise. The US has a different economic exposure, and we see the US as the market is seeing it. Because, by the way, since the start of this war, US is in positive territory in financial markets. The S&P 500 on Thursday, not yesterday, but the Thursday last week, ended the session in positive territory, and that is a message. At the same time, Europe is totally non-independent from an energetic point of view. So that gap is going to be shown in financial markets and in the performance of the indices in both sides of the Atlantic.
So if we're thinking about possible scenarios and impacts of this war, what would you describe as the best and worst case scenario in financial market terms, investment wise, for the outcome of this conflict? And what do you see like the most likely scenario?
Look, the most likely scenario, because we have best and worst scenario of what is going to happen as an effect of the war. But let me address the war as an effect on financial markets. There's only one scenario, and is that volatility will remain very high, but at the same time, in regards to real performance, it's going to be days or weeks that this is cleaned from financial markets. I know that this can sound very superficial when talking about this, when we see what we see in newspapers, in TV, etc., what is happening on the ground. But I have to address financial markets, and this is the effect. We have analyzed many geopolitical risk events over the history, and there are some that last months, but normally is days and weeks. And the longer it is, it's normally due to a higher economic importance of the actors in play. And Russia, before this event, represented only 1.3% of the global economy. That makes Russia irrelevant from an economic point of view. Now, Russia and Ukraine are not irrelevant from a commodities point of view, and that is the effect down the road. The most likely scenario of that is from an equity point of view, is that Europe, some sectors in Europe are going to have a hard time adjusting to the new prices, to the inflation that this is producing in some commodities. Also, some managers, and that affects both equity and fixed income. Some managers will have problems trying to adjust to the effect on the economic growth, but of this inflation that is being produced on commodities. And that will mean that we will all have or are readjusting our view in regards to monetary policies. Our view on that is that the most likely scenario is that the ECB, the European Central Bank, doesn't increase the rates this year. And that's also what the markets finally are seeing these days. And that the Federal Reserve will increase rates, but at the same rhythm or speed that we were thinking since November, December last year. That would be around 4 to 5 quarters of increase in order to manage an economy that is growing, because that is something we shouldn't forget. Growth will still be positive this year in the US and globally. We are going to suffer first quarter, most likely also suffer second quarter in Europe, but the end of the year should be positive.
Okay. I'm happy to announce that we've got some questions from our viewers in the meanwhile. So I'd like to share them with you. The first one is from Thomas. He has a very common question, and I think a bit in line with the last thing you said. And many investors will be particularly interested. He says, is it a good time to invest or is it better to get out? Is it still too much volatility in the markets?
Never is a good time to get out. And always is a good moment to get in. We in Openbank believe that market timing doesn't add any value. And what adds value is to maintain your wealth planning, to maintain your path or the commitment that you have with yourself in order to invest and to build your investment throughout your life. Now, is it a good time? I'm going to rephrase the answer if I may. Is it a good time to de-risk the portfolios, or is it a good time to add a little bit of risk? We believe it's a good time to maintain the exposures, and that is a decision, and a very difficult decision in times like this. Maintain the positions you have if you believe you are at the center of the risk that you can assume. And we are looking for the moments or the scenarios with less volatility, with less blurred scenarios or situations to add risk in certain pockets. The US, for example, or North America in regards to equities, more into China, both on debt that we did it 10 days ago, and we believe we could add a bit more, and also on equities. And a very important bucket in our sources of return and risk, which is inflation-linked bonds. We reduced inflation-linked bonds back in November, December, I believe, and we see now the same situation that we had back in the summer of last year, which is inflation is going to remain spectacularly high for some months, and at the same time we don't see many interest rate hikes, none in Europe, and that will make inflation-linked bonds to profit from that inflation, and at the same time not suffer from an increase in interest rates.
No. Okay, and I've got a question from Jeroen. He's now in strategy 4, New York, yeah, and he's not feeling comfortable. So would you recommend him moving to a more conservative option?
Look, in line with the question that I've just answered before, no, not at all. If Jerome is okay and he's in his risk with portfolio, with strategy New York, that is the strategy that in my opinion should be followed in that case. What we are looking for New York and for all the strategies and analyzing is if we increase a little bit the risk. But now reducing, and for example, a day as bad as today, let me look in my mobile phone. Right now, indices in Europe are falling between 2%, 3%. That is a bad day. That is the worst day to get out, because what you will do is acquire the losses without recovering the next day. And back to what I said before, if you see in history other geopolitical risk events, what happened in financial markets, the message is do not allow that volatility derails you from your plan, makes you forget about the plan that you have for your wealth, because what you will do is earn the losses without earning the potential recovery of the days ahead.
Okay, so Anna, actually it's funny that the questions are aligned, because Anna is mentioning that she currently has a Shanghai strategy, which is one of the lower risk strategies we offer, and she's considering moving to a high risk level for her portfolio. Do you think it's a good time to make this change? I understand from what you're saying
Well, look, the question to Anna, and sorry Anna, maybe for being too direct or provocative, is why were you in Shanghai if you could be in a riskier strategy? Because for us that would be a decision of a term horizon that is shorter, and that's why you go to a more risk averse, a less risky strategy. But if not, yeah, whenever is a very good moment to go back to the risk that is optimal for you, which is what we measure with those questions before subscribing the robo-advisor.
Yeah. And Chris wants to know your outlook for emerging markets. Is it a good time to take positions?
Look, it's a very good question. We believe that emerging markets, and I will put Asia Pacific here and China, insert them into the question of Chris's question. We believe are regions that will benefit of some dynamics that are happening there and globally. There are emerging markets are in a very different point in the cycle of monetary policies. China is easing its monetary policy, and other emerging markets are at the peak of the restrictive monetary policy, and then we don't know when, and it depends on which country, but starting to ease in the following months. So that is favorable. With what is going to happen with Europe and how Europe is going to suffer, we believe also that flows will go into emerging markets, and yeah, both from a debt point of view and from an equity point of view, are markets that we view as very favorable. In our last investments committee 10 days ago, we reduced equity exposure of North America and Europe, and we moved it into emerging markets. So it's something that we are signaling since some weeks now. Let me add also that Japan, although it's not an emerging market, is a market that we believe that with this situation could benefit in the following months.
Okay, and then we have another reader of our market flashes we sent by email. Sandra, she's one of our customers, and she's noting that since the beginning of the year you've been a bit negative on fixed income, but now equities don't look like a safe haven. She'd like to know if you are positive on fixed income again.
I am less negative on fixed income. We are less negative on fixed income in Openbank's investments committee, and we are less negative because we believe the rate hikes path, especially in ECB, is delayed, so to say. That will allow us to gather return opportunities. We have included China debt in our last investments committee. We believe that these last weeks in which the yield of the European bonds have gone down, that has favored fixed income, and we are less negative. But in equities, we are still positive. There is, and I want to be very, very, very certain on this. We are going to see positive economic growth, although the news let us think that this catastrophe is going to affect the economic growth wildly. It is going to affect, but not wildly. We are going to have positive economic growth by year end. That means that equity markets should benefit. How much? That is the question. We still see returns in equities below double digit. That means 7%, that means 5%, 6, 8% positive this year. Yeah, that's what we see. But not, of course, a spectacular performance from equities as we saw in 2021.
Okay, David has a question on the changes you make in each of the strategies. How do you come to these decisions?
Mm-hmm. Well, after a very thorough process and after a lot of discussions, but let me summarize it in what I believe it's the key benefit of our investment philosophy, and is we manage David's portfolios and all the portfolios of our clients based on a measure of risk. We don't manage them based on neutral exposure or strategic exposures to equities, to fixed income. We define a risk target that we want to aim for the next 3 years, and we have ranges of risk which we cannot, of course, surpass. And for example, the most complex to see is Kuala Lumpur, which is our profile 1. It has a risk target of 300 basis points, or 3%. 3% risk is a very, let's say, short volatility ratio. How do we address it? We believe that based on our views on equities, on fixed income, on money market, and on real assets, we may compose this 3% of risk based on 5 sources of risk. Risk of equities, risk of interest rates, risk of credit, risk of inflation, and risk of effects of currencies. And we start to simulate what are the best distribution of that 3% among those 5 risk sources. Today in Kuala Lumpur, you see higher than 100 basis points, higher than 1% in equities, just short of 1% in credit and in interest rates, and well, marginal exposures to inflation and effects. And that, based on what we believe is going to be the return of those asset classes going forward, in a very cumbersome and complex risk algorithm, gives us a strategic asset allocation and a tactical asset allocation that we believe is the optimal. So we don't focus on, we want Japan equities, we have to put 2% more. No, what we see is what we put more risk in equities or not, and what is, based on that risk we are adding, the expected return. If the risk is larger than the expected return, that is a change we won't do. I hope it was good enough.
I think it's a good explanation. I think it will help many of our customers understand the way of working. So I'm afraid, Gonzalo, that we are running out of time. But hopefully we'll be back having you for a new live market flash someday soon. I want to thank all of our participants for connecting and for sending the nice questions. Gonzalo, thank you once again for your time and for sharing your insights with us. It's been a very interesting half an hour.
Thank you, Nikki, for your help, for your very well-guided set of questions and how you have put the questions from our audience in. And thank you to all that have attended this live market flash. I will be. It will be a pleasure to be here as many times as you deem appropriate, because in this situations in which our clients see these losses in their strategies, in their money, we have only one duty, which is be close to them and let them know our view. And our view today is that selling, getting out of financial markets is a certain loss, a concrete loss, a sure loss. And in times of volatility, you don't want to make those momentary losses be a loss that you earn, but to make them recover. And that's what we need to transmit and to communicate our clients to stay invested. In history, there's a lot of events like this one, and the correct way is to stay invested and to protect your wealth and your portfolios.
Thank you.
Thank you.